Say, for example, at an annual growth rate of 7%, a $500,000 property will be $983,000 in 10 years. That's significant capital growth, even if I sit on only one property. However, as the property grows in equity, I use that equity to fund more and more assets, and I sort of buy an asset every 2.5 years.
Yes.
And by 3 or 4 assets, wow, that growth is significant. Definitely good enough to pay off your principal place of residence.
Yes.
And have good cash flow. Our property is providing you good cash flow with rents. And if you have a property in self-managed super funds in that too, that funds your retirement through the pension. So that is crazy growth. Hello everyone, and welcome to another episode of Building Generational Wealth through Strategic Property Investment. I'm your co-host Sandeep Jagtap, Director at Finsource Mortgage and Finance Brokers. And with me, as usual, I've got our knowledgeable co-host, George Churchian, Founder and Director of James Chase Bias Advocacy. George, welcome and good to see you again.
Very good to see you again, Sandeep. Can't wait to get stuck into it.
Yeah, absolutely. Look, so much happening around us all the time. At the moment, there's so much uncertainty, and that's a great opportunity as investors for us. So, a lot to talk about today. But before we go any further, a disclaimer: this is not financial, accounting, or legal advice. We are here to have general discussion about investment strategies and what we have done with ourselves, with our clients, and our fellow professionals. Right. So please do not act on any of the discussions here without taking proper financial and accounting advice. Let's get started, George. So, in the last few episodes since we started, George, we have discussed about how should we have a strategy to build wealth through property.
Yes.
And as we always said, that property is not a 6-month, 1 year or 2 year game. It's a long-term game. So what we are going to talk today, George, I thought was how a 10 or 15 year horizon in your property investment journey can be really worked out in such a way that you build significant wealth over 10 to 15 years through property.
Yeah, that's a great thing to discuss. We've laid out the fundamentals previously, and some of the things you and I have both spoken about are essentially, discovering what our reason for investing is in the first place. So, and that reason can be different for everyone else. There's no right or wrong answer. It's just about knowing what's right for you, and then you build a plan and execute accordingly. So today, I guess we'll we'll use a scenario where someone's already built a portfolio. And what next?
Yeah. And if somebody wants to sort of plan out their 10 or 15 year horizon, what can be achieved?
Absolutely.
So, excuse me, George. So, when it comes to property investing, George, we say we can't look at, this area or this state has done well in the last 2 years and I want to go there. We have to look at over a 10, 15 year horizon. Why do I say that? Is because if you look at the rule of 72, what does the rule of 72 say? If there's a certain amount of growth annually, how many years does it take my investment to double? Say, for example, I've got 8% growth per annum, and by the rule of 72, it take about 9 years to double. Every 9 years, the asset will double. So, really, that compounding growth is what helps you build the real capital growth as such. And that's why one needs to look at a 10 to 15 year horizon when it comes to property investor. Would you say it's a fair assumption? Yeah.
I agree completely. So when we are talking to clients, we very much do want to take a long-term approach. And unfortunately, I guess because of the buyer's agency rise and the prevalence of using a buyer's agent at the moment, the last several years, I should say, the short turnaround or the short uptick is something that's marketed heavily, right? But to your point, and personally, I always like to bring it back to fundamentals because property works in cycles, as you've pointed out, and depending on the market, that cycle could be anywhere from 7 to 14 years. And the important thing is to understand how that works. It's to understand compounding, as you've pointed out, and typically that's what we've seen create wealth over the last several decades.
Yes. And to support what we are trying to discuss here, I've got some data. As you know, I love data. So since I said that rule of 72 and say 8% annual growth probably take 9 years for the asset to double. So I thought get some growth by capital cities over last 10 to 15 years. So what has each capital city done? And when I'm talking about the 7 to 10 year growth, it takes into account a lot of activity. So if you're looking at 10 to 15 years here, we are looking at the post GFC recovery,
Yes.
then the meltdown, and then the COVID,
Yes.
and the post COVID, and everything, and the recent growth in certain capital cities and slump in certain capital cities. So the longer the horizon, it sort of takes into account a lot of ups and downs and sort of streamlines the growth and the rate of growth over a certain period of time. So if I look at by cities, capital cities, Adelaide has grown 7.2 to 7.6% in last 10 to 15 years. Hobart 7.1 to 7.2, Brisbane 7.1 to 8.4, Sydney 6.2 to 6.6, Canberra 5.6, Melbourne 4.3 to 6.9. That's a wide range. However, this accounts for the slower growth in Melbourne in the last 3-4 years. That's why the range is high, but still the lowest possible annual growth you're looking at 4.5%, which is not too bad.
That's quite good.
Yeah. And Perth, after all the run you've seen in the last 2 to 3 years, over the last 10 to 14 years, it has shown a growth of 4.1 to 4.3% and Darwin 1.1%. So, George, that sort of is a little bit of data about how the capital cities have done over 10 to 15 years. And the surprising comparison, I would probably say, would be Perth and Melbourne, because in Melbourne, there's so much negative talks we see everywhere about, Melbourne has not done anything in the COVID, post-COVID, and while other cities have gone 30, 40, 50, 60% up. And Perth, which has been absolutely in every discussion, every video, and everywhere, and everyone's trying to buy there. If you look at the 10 to 15 year graph, we're looking at 4.5%. So Melbourne 4.5%, Perth 4.5%. And Melbourne has been absolutely beaten down over the last few years, and Perth has been in everyone's talk. So what would you say over the 10 to 15 years? How do you see that? Or how do you see these cities having somebody going up at a time while somebody takes a backseat, and then vice versa?
Yeah, so that very much, I think, validates the point we were making earlier around having a long-term horizon and also understanding property cycles. So Perth and WA, if you go back a little longer than the 10-year period, early 2000s had a median price point higher than Sydney, right? So
Yes.
So they were multimillionaires in Greater Perth because off the back of the mining boom. So that's what was really stimulating the market at that time. But I'm also old enough to remember what happened with that post that period. So the prices regressed back to where they should have been or where they were consistently. So when you look at the most recent burn, and to my point earlier around understanding cycles, it's around also being comfortable with where you're entering the market. So unfortunately, just due to the hype and the content that we consume, a lot of people followed the crowd with Perth and South Australia. And yes, they may have made some handsome gains, but if you ask them to explain where those particular investments sit in a cycle, I don't really think too many people would be able to tell you that. So I guess, again, going back to the Melbourne difference, yes, it's been beat up. It's been the ugly stepsister for the last several years, but it is a global city at the end of the day. And
one of the most livable cities, as per a few sort of reviews recently.
Absolutely it is. So it's got a long coloured history. It's up there with Sydney, and a state like Victoria won't stay down. And we've certainly seen the resurgence of that over the last couple of years.
Yeah, and look, George, if I recall my discussions with a few clients or few friends, probably about 7 or 8 years ago, same was being talked about Brisbane.
Yes.
Not too many people wanted to go that way.
No.
Probably mid 2015, 16s. That is the time when nobody wanted to go there. And we were picked properties in 300s at that time.
Yeah, certainly. And even most recently, even a few years ago, obviously the last 5-10 years, people have been paying closer attention to those markets. But there was a point in time where the attention suddenly shifted to the West Coast.
Yes.
But then once that boiled over, again, the crowd started coming back to, the Townsvilles, the Rockhamptons, the Greater Brisbane, because there's a lot of value there still. It's slightly, from a price point perspective, like Metro Brisbane is not far off from Sydney in some markets, but there's still a lot of value to be had. And when you look at internal domestic migration patterns, you can see why.
Yeah. And that's where I think, George, when we sort of look at a 5, 10, 15-year horizons, and we take out the noise and short-term cycles in there, we can see that stable growth of 6 to 7%, at least that can be seen in the property prices.
That's right. And I think that's quite a modest figure as well. And when I'm speaking with clients around projections in terms of how their investments are expected to perform and grow over the long-term cycle, we do want to use modest figures like that. So to your point, when someone's entered a market and they've purchased back then an $800,000, $900,000 asset in Sydney with a growth of 6% annualized, that's not bad. And when we look at, some of the previous generations who purchased property in the late 80s, even in the 90s, so you're talking suburbs in Greater Sydney for under $1 million. So those properties are now 4 or 5x in value.
Yeah.
So they didn't go in thinking we're going to create wealth. That's just the market and compounding doing its thing.
Absolutely. And these figures which I've said, George, or mentioned is the growth over the 10 to 15 years. What key factors have happened in the Australian economy during that period is the post-GFC recovery, the 2010 Sydney-Melbourne boom, the 2020 to 22 pandemic surge, and mid-2020 shift, mid-sized capital city surge like the Perth, Brisbane's and Adelaide's. So everything that has happened in the economy has sort of been a part of these figures. So that brings us back to the discussion where we started from, that how does a 10 to 15-year horizon look in your portfolio building journey, and how can you use that to generate wealth and fund your retirement?
Yeah, it's a great question. So typically, we want to start off by making the correct investment at the very outset and knowing what we're in for over the long term, as you've explained, because the wrong investment initially can either make or break your investment journey. And what we're talking about is an expensive endeavor. So there are transaction costs involved. So typically when the correct investment is made, what we want to see and what we talk to clients about is how does that get you into your next property? So we want high growth assets. We want a balanced yield, something that doesn't impact your lifestyle in terms of holding costs. And then once compounding does its thing, whether it's 12, 18, 24, maybe 36 months, we then look at that and go, you know what, I've been able to save an X amount of dollars a month, but the way the property's grown, it's grown significantly more than what I could save. And then we would have a conversation with yourself and say, Sandeep, this is what the property has done. I think I'm ready to purchase my next property. And is that something you can help me with?
Yeah, and that's a very valid point, George, because the growth in the assets fairly outweighs the rate at which one can save.
Especially now.
Yes, and that's where I think adding more and more assets and using debt to fund that growth responsibly,
yes,
is key. So one cannot think, I bought my first home, I'll try to pay it down as much as possible, 60, 70%, before I buy my next investment. And then that next investment may be 8 or 9 or 10 years away. By the time you would have had significant growth in the asset if you would have funded it earlier. And funding it through equity.
Yes,
in the property which has grown. So if we say 8 to 10% growth a year, within 2.5 years, that first property would yield some 10, 20% capital increase where you can extract the equity while you save some money as well. And then you can jump into the second asset.
that's right. And I like the point you make around, whether one decides to aggressively pay down their loan or not, because we do see that, and I'm sure you do as well. And again, it's not financial advice, but you sort of look at that and say, look, there's capital that's being deployed in a particular way. Is it an efficient use of the money? Is it tax deductible? And the answer is that it's not. Then you sort of go, well, that's one option. And it could be right for the individual. But then another option for someone who wants to grow their wealth or invest in property, grow their portfolio is, or you sort of look at that and say, well, instead of paying down that home loan or the principal place of residence, then we will deploy that capital into the next property. And this is where the strategy, I guess, comes in. So you might have your principal place of residence, you might have an investment property, you might be in a position to go for a second one. And as each one compounds and grows, it gets you closer and closer to the major goal at the end.
Yeah, and a typical client who we closely work together with probably have a portfolio, at least a portfolio of 3 or 4 properties, plus a property or 2 in self-managed super funds. That's a very good asset base,
yes,
to build capital over year, capital growth over the year, and fund your retirement.
Yes,
and sort of have that principal place of residence paid off, rather than having a 30-year loan term, be in a position in 10 to 15 years where you can sell off a couple of assets and sort of pay down your principal place of residence, rather than pinching your pocket to pay down the debt faster. Invest in more and more assets if your cash flow permits and your lifestyle permits. So having that discussion with your professionals like yourself, accountants and financial planners ourselves, to make sure you are just not doing it because it's been talked about in certain episodes and certain podcasts and all, but you understand where you fit in there, what suits your sort of goal.
Certainly, and that's an excellent exit strategy, right? So, and I know we've collaborated recently on a few clients who are using their portfolio to ultimately their end plan or their end goal is to pay down their principal place of residence mortgage.
So, and they're funding their growth.
Yeah, absolutely, and that's a fantastic use of your portfolio and why one may ultimately decide to invest and grow a portfolio. Looking at if I'm going to decide to live in Sydney, looking at current prices here, it's not a state secret. It's very expensive to buy a home in Metro Sydney, especially if that's where you need to be. We're talking multiple millions at entry level. So when you look at the growth of income, it hasn't actually sustained and it hasn't grown. Incomes haven't grown at the same rate as what property prices have. So you look at that and you say, well, if I'm not going to pay my mortgage down through my income, through my PAYG salary or business income, then what's another way where I could extract large chunks of capital and pay down that loan when I'm nearing retirement? It's property investing.
Yeah, and one more data point, and that's interesting one which I found through my notes over the years with a lot of clients and their strategies we have sit down with over the years. Say, for example, at an annual growth rate of 7%, a $500,000 property will be $983,000 in 10 years. That's significant capital growth, even if I sit on only one property. However, as the property grows in equity, I use that equity to fund more and more assets, and I sort of buy an asset every 2 to 2.5 years.
Yes.
And buy 3 or 4 assets. Wow, that growth is significant.
My goodness.
Like, definitely good enough to pay off your principal place of residence.
Yes.
And have good cash flow. Or properties providing you good cash flow with rents. And if you have a property in self-managed super funds in that too, that funds your retirement through the pension. So that is crazy growth at a very conservative rate of 7%. And a $500,000 loan, if that property was 100% funded by loan, a $500,000 loan with P&I interest rate of 5.75 flat over 10 years. So I'm not saying a single interest rate cut.
No.
That loan would come down by $100,000 and the property will grow by close to $500,000.
Yeah, that's really fascinating. And the thing is, we're seeing that play out now over the last few years where you've had sort of Greater Brisbane, some regional markets in Queensland, WA, Victoria, South Australia, $500,000, $600,000 properties that were purchased. I personally have purchased things in regional Queensland under $500,000, less than 3 years ago, and those things have doubled in price. So we're seeing it happen right now.
I was looking at a contract one of our clients signed in May 2017 in southwest of Brisbane for $249,000 to purchase a property which we recently refinanced, and the property was valued at $800,000. So
Wild.
That's wild. And when people say, look, but we pay a lot of interest over 10 years, this and that, and how can you say this is capital growth and whatnot? So I looked at some interest rate history figures in 2010. Can you guess what would it be the housing interest rate in 2010?
So 2010, that was post GFC.
Just post GFC, yes.
Maybe in the 7s?
Yes, you are
7.35?
You're very close to it. It was a bit at 2010. It was anywhere between 6.5 to 7.8. The cash rates were 4.5, and the bank margins were 3.2 to 3.3%.
Yes.
And we were talking about 7.6 to 7.8% interest rates.
Yes.
So fast forward 15 years, we are close to that 6s. So interest rates hover around that, anywhere between 4.5, 5 to 6.5, 7s.
Yes.
Right?
Yes.
And one significant thing, the banking reforms and so much revolution in this banking and lending system, the margins of the lenders have gone down from 3.3% to 2%.
Yes.
Rise of mortgage broking and growth of mortgage broking, having professionals to help them,
More access.
and more access to more lenders, more products, and tailor their portfolios as they go. So those are the things which have helped people to borrow more effectively and fund the asset building phase, so that they build that capital growth over the number of years and are in a position to pay down their principal place of residence and build wealth for retirement.
Yeah, that doesn't surprise me. I mean, every time we've seen a global crisis, and I know we're going to talk about in a different episode the psychology of the investor, but every time we've seen a global crisis, our markets remain quite resilient, and it comes down to good fundamentals. So I think the opportunity is certainly there. And to your point earlier, there's always reasons that we could talk ourselves out of doing something. But then when you sort of look at, the cons of one thing and then the pros, in this case, certainly the pros outweigh the cons.
Yeah, and we will definitely talk in the next episode about the current global conflicts and the global economic pressures we have. Not a great thing, not a great environment to be in. However, as investors, I would not be scared, but I would probably be cautious and be ready for an opportunity soon enough when things start getting better.
I think so. And that's the minority of people, Sandeep. So it's being prepared. You've got the experience behind you of having seen events like this before, and you've observed the property market. You understand the cycles. You're ready to go when the opportunity arises.
Absolutely. And that's what we investors need to think. Yeah, at the moment, if you look at the stock markets around the world, they're crashing like anything. Some people call it a crash, some people call it a correction, depending on how scared are you. Yes. And I think if I look at the crashes in the stock markets over the past years, what I've always seen is from the peak where the market crashes from and goes to the bottom, when the market recovers, the next peak is way above the first peak. So
Yes.
if you can sustain that short-term corrections and short-term volatility as such, and be ready for the next investment opportunity when it arises,
Yes.
you got significant opportunity to grow your wealth over a number of years.
Yeah, I agree completely. We've seen it time and time again with all the events you mentioned. So GFC, the pandemic,
The Royal Commissions, whatnot.
Royal Commissions, COVID. So it happens. The market fluctuates, but then the rebound is always a lot more aggressive than the initial drop.
Yeah, so going back to where we started the topic on, so a typical investor, if your lifestyle, if your incomes, if your family sort of situation which changes from time to time, the kids are, two people start a family, then they have kids, the kids grow up, they go to their next stage. So all those stages factored in. If a typical investor can accumulate assets, not at a crazy speed. We've seen a lot of videos where people say about 6 properties in 18 months and all, and we don't go that. We don't want to sort of talk anything like that. But if we are able to sort of capitalize on the equity that we grow and try to target an asset every 2 to 3 years,
Yes.
and accumulate probably 3 to 4 assets and a property in a self-managed super fund
That's a solid bet.
over 10 years, which is your accumulation phase.
Yes.
And then you move to your consolidation phase before you plan your retirement. So that is the entire, over the number of episodes we have talked, these 3 phases, and that's where funding the acquisition phase so smartly, rather than waiting to pay down the debt, see where the opportunity arises. In the first stage of investment, Sydney might be the market I would be possibly ready to invest, and then Melbourne or Brisbane starts their growth, and then there is Western Australia and Adelaide. So you'll have assets in multiple geographies,
Yes.
bought at various different price points, different points in the cycles in the cities, and using that capital growth to capitalize and buy asset as quick as possible.
That's very much the formula, right? So like you said, you don't stress yourself out. It's not meant to apply undue pressure, and the number I think needs to be reasonable and realistic. Everyone's situation is different, but then at a point in time, once that foundation is there, you look at it and say, look, I still have a bit of time until retirement, or I've gone through a consolidation exercise, but then I'm going to dip back into acquisition. Then you have a bit of a look and think, well, what's the right asset class for me? Is it continuing to add residential? It might be. Or is it time to explore a different asset class like commercial or something else?
Yeah. And that's where I think, George, a lot of people will invest in Queensland probably in the late 2020s, like that was the market to go. Then early that post-COVID time, a lot of Perth and Adelaide
Yes.
took stream, and who knows, 2026 onwards, it may be the Melbourne run which comes across.
Certainly. So in terms of what I'm seeing very quickly is not too much activity, to be honest. WA, South Australia, like the inquiries that we get, the discussions we have are pretty much based off people exploring those markets because their friends have gotten in and they've gotten in a few years ago. They've seen an uplift. But from a strategy perspective, very much we're looking at places like Victoria, regional markets, Greater Melbourne, Greater Brisbane, Gold Coast, and some regional markets north of Brisbane.
Yeah, and one needs to not start somewhere and set that strategy in stone, but have that review, which in maybe a couple of episodes ago we said a review in December and review around June.
Yes.
To see what is our long-term goal, how are we tracking, how are we traveling, and wow, we bought this property with the expectation that we will have good capital growth over 3 years, but it has done well in 18 or 20 months. So can we prepone asset purchase again and fasten our acquisition process so that we get to the consolidation phase faster?
A lot sooner, certainly. And I think that review phase also sort of highlights opportunities for assets that are performing. So there are times when I get in front of people, they've made an investment themselves, whether it's a unit or something in their own backyard, and they've held the asset for 7, 8, 9, 10 years. It's cost them a fortune. It's eaten into their borrowing capacity. That regular review will ultimately go, well, you know what? We've actually made an error here. Do we pivot, transact the asset and start again? And there's nothing wrong with that, right? So we learn along the way.
Control loss is absolutely key.
Yeah, we learn along the way, because if you're able to recalibrate, then it could really open things up for you.
Rather holding it as and waiting for it to grow over the number of years, is there another market which is doing really well? And what is the cost of correcting course?
Yes.
And how sooner can we recoup that money and start building again? The key thing here is, George, not to follow the crowd, filter the noise.
Agreed.
And really work with professionals for your customized plans.
Yes.
Like us, a lot of people do podcasts, a lot of people have their YouTube channels and whatnot. Someone can't listen to them and sort of take a leaf of that book and start.
No.
One needs to calibrate where they stand with the help of professionals like the financial planners, like the accountants.
Yes.
To understand, this is my age, this is the family plans, this is what my employment looks like over the next 10 years, and this is what my goal is. So that is the start of the plan. And then every 12 to 18 months, put a small piece into that puzzle so that the final puzzle comes up.
It reveals itself. I couldn't agree more. And, whether it is talking to a broker, an accountant, or other professionals, you might think you've got a understanding of your position, but having someone independently, impartially look at it might actually change your view on what your position actually is, for better or worse. So I think it's very, very important to go through that assessment process, understand where you are, understand your risk appetite, your time horizons, and then make decisions accordingly. I really don't recommend anyone listen to a podcast or download a white paper and then make a decision based off that. Unfortunately, it's something I see over and over again, but you're probably doing yourself a disservice.
Yeah. So what else, George, to add to that 3-phase building strategy? Because the key takeaway for me from this episode was to make sure you capitalize on your situation every 2 to 3 years, if responsible lending allows you to do it, and if there are markets at that time which allow you to get a step into the markets. So that, I think, is the key step, and everything else will follow.
I think so. It's essentially growing your asset base and then regularly traversing through your acquisition consolidation phase, because it's also important to realize climates like we're in at the moment, where there are a lot of pressures globally, economically, and otherwise, cost of living. And you sort of look at that and you go, I might be in a position to make a move, but I'm going to hold off. Or you might look at that and go, I might be in a position to make a move, but that next move should be counter-cyclical to hedge against what's happening economically. So traversing in between phases sometimes is not a bad thing, because you can consolidate, and then that will put you in a position to acquire again. And then as you sort of near, and you pointed this out earlier, you near your retirement age, it's about sort of consolidation, making sure you've got maximum value extracted, reduce your holding costs. You may consider divesting in some assets to really sort of plump up your cash base, of course, in accordance with advice from your advisor.
Yeah, and if I look at my own situation over the last 10, 15 years, George, what I've realized is the rate at which I can save and the rate at which my investment grows, there's a huge difference. With my cash flow, how much can I save a month? Just I bought a principal place of residence and I'm saving money, as against whenever an opportunity comes, I invest, and after a certain point, I have 3 or 4 assets growing at 7% per annum. I know I've funded that with debt.
Yes.
But then I've got 7 or 8 buckets or 4 or 5 buckets increasing at 7 or 8% per annum.
Absolutely.
Plus the tax incentives they have to hold the properties. The holding cost can be worked with the accountant to see what can be offset, what can help to offset your tax. So what is your gross holding cost and net holding cost, and as compared to the growth you can get out of that asset? And that's only one asset. And if you have got 2 or 3 assets plus an asset in super fund on top of your principal place of residence, you are talking close to 20-30% growth per annum.
It's a good analogy, because when you look at that bucket, and we're obviously talking about having 3 or 4 or 5 buckets, but when you look at one bucket and you sort of go, I've just made a purchase, it might be 80% debt, right? So then over time, that debt ratio will decrease. So when you're ready to either consolidate or divest your investment, you might look at it and say, well, the bucket basically is now this big, only a third of that or a quarter of that is debt. And that's the miracle of compounding. So you've essentially created equity. And then you might go, okay, well, if a quarter is debt, you might add another 5% for transaction costs, interest, maybe a little bit more than that. But then you've got a whole, more than 50, 55, 60% that is just cream. And imagine having that across 4 or 5 buckets. It will do more than just pay off your principal place of residence. I think it will fund your retirement and give you a good lifestyle.
To put it in dollar terms, just throwing numbers out there, $2 million portfolio to start with, like or year 3 or 4, we go to $2 million portfolio, debt of 1.8 million, so highly leveraged portfolio, hold it for 10 years, 7% growth per annum, 3.5, 3.6, 3.7 million. The debt from 1.7 million, 1.8 million goes to 1.6 million. Then that gap, $3.8 to $4 million to $1.6 million. That's where your real growth has been.
Yes. Yeah. And you can tap into that along the way to allow you to continue growing.
Yeah. So it's not magic. It's not, wow, we can do that in 12, 16, 18 months. I'm not advocate of that. I myself am a responsible investor. I believe in responsible borrowing myself. Apart from being a mortgage broker, it is all about, can I afford this? And the most difficult period in the investing journey, George, is the first year and a half after you buy that asset. Yes. That is the most difficult period, because the price to the loan ratio is maybe highly leveraged.
Yes.
But as you get a hang of the repayments and the holding costs and the asset starts growing, that's when the comfort zone arrives, right? And that's where I think one needs to understand slowly. I do not need to compete with George. George has 6 properties and I only have 2. Who cares? I have to compare with where I was yesterday, where I am today, and where I want to be in 7 years. Yeah, I can get some guidance of George being a professional. George, you have done this, you've been there. What was your thinking while you did that, and how have you achieved it, and how can you, as a professional, guide me to be through that process? Rather than just blindly comparing, saying, oh, George has 8 assets, we do podcasts together, I need to get to 8 assets quick.
Yeah, absolutely. And I think even during that initial, it's good you pointed out the initial 12, 18 months, because I agree that would be quite tough. And especially if you're in a rising interest rate climate, right? So it's sort of doubled the amount of pressure. But you sort of look at that and go, yes, I could sort of, cave and struggle through the pressure, but I could also, draw some learnings from that too. So because ultimately, if you could survive through that period, the tough time, then when things are a lot more favorable and conditions are a lot more favorable, then you sort of look at that and go, okay, well, I made it through the worst. What can I do next to try and grow.
So that's, I think, the time we have for today's episode, George. So what we've really learned today is how to use responsible borrowing or funding or debt to grow your wealth, and how it is a long-term game, and how every time you go to invest, it can be a different market, different state, maybe a capital city, maybe a regional town, maybe a townhouse, maybe apartment, what development sites and whatnot. So it's a long-term process. It needs to be calibrated. You need to be consulting the professionals to understand your risk, understand your capacities, understand how your path looks like, and that's how one needs to grow.
Absolutely. And if done right, it might just help you pay down your mortgage.
Great. And the next episode, George, we'll be talking about 2026 and the top-sitter we are having since the year started.
Absolutely. So we're going to talk about the psychology of the property investor, because if it feels like COVID wasn't all that long ago, and some of the things that are happening now are very much reminiscent of that. And we've been having separate discussions. So I thought it might be good for us to unpack the buyer psychology in a climate like this.
Great. Looking forward to it, George. Thank you everyone for tuning in today, and see you in the next one.
Thank you, Sandeep. See you, everyone.
See you, bye.